Today, we're diving deep into a topic that is fundamental for anyone interested in trading or investing. How do markets actually move? It might seem like a chaotic mess of flashing numbers and squiggly lines, but I promise you, there's a logic behind it all. By the end of this video, you'll have a solid foundation for understanding the forces that drive price changes in any market, whether it's stocks, crypto, or Forex. So, let's start with the absolute core principle. Price is simply the result of supply and demand. That's it. It's the most basic economic concept, and it governs everything. Think of it like an auction. If there are more buyers than sellers, meaning demand is higher than supply, the price goes up. Why? Because buyers are willing to pay more to get their hands on what's available. On the other hand, if there are more sellers than buyers, meaning supply is greater than demand, the price goes down. Sellers have to lower their prices to attract the few buyers that are out there. Every single tick up or down on a chart represents this constant battle between buyers, often called the bulls, and sellers, known as the bears. When you see a price chart moving, you're literally watching a visual representation of this supply and demand dynamic playing out in real time. A long green bar means buyers were overwhelmingly in control during that period. A long red bar means sellers dominated. Now, how do we visualize this battle? The most common way is through something called a candlestick chart. If you've ever looked at a financial chart, you've probably seen them. They might look a bit strange at first, but they are incredibly informative. Each candlestick tells you a story about what happened to the price over a specific period, whether that's 1 minute, 1 hour, 1 day, or even 1 month. Let's break down a single candlestick. It has two main parts, the body and the wicks. The body is the thick, rectangular part. It shows you the opening price and the closing price for that time period. If the closing price is higher than the opening price, the body is usually colored green or white. This is a bullish candle, showing that buyers won for that session. If the closing price is lower than the opening price, the body is usually red or black. This is a bearish candle, indicating sellers won. Then you have the wicks, which are the thin lines sticking out from the top and bottom of the body. They look like the wicks on a candle, hence the name. The top of the upper wick shows you the highest price reached during that period, and the bottom of the lower wick shows the lowest price. So, in one single shape, a candlestick tells you 4 key pieces of information: the open, the close, the high, and the low. It's a complete snapshot of the battle between buyers and sellers. For example, a candle with a long body and very short wicks tells you that one side was in control for most of the period, pushing the price decisively in one direction from open to close. A candle with a small body but very long wicks, on the other hand, tells you there was a huge tug-of-war. The price swung way up and way down, but ultimately, it closed very near to where it opened. This suggests indecision in the market. By learning to read these individual candles and the patterns they form together, traders can get clues about market sentiment and potential future price movements. It's like learning to read the market's body language. But the story doesn't end with individual candlesticks. To truly understand market movements, you need to consider the context of asterisk. When asterisk, these movements are happening. For global markets like Forex, which trade 24 hours a day, 5 days a week, this is especially important. The market's behavior changes dramatically depending on which major financial center is open for business. We typically break this down into 3 main market sessions: the Asian session, the London session, and the New York session. Let's start with the Asian session, which is the first to open. This is often referred to as the Tokyo session. It's generally the quietest of the 3. Liquidity, which is the amount of buying and selling activity, is usually lower. Because of this, you often see prices consolidating, meaning they trade within a relatively tight range. Major news from countries like Japan, Australia, and New Zealand can cause spikes of volatility. But for the most part, it's a period of calm before the storm. Many traders see the Asian session as setting the stage for the day, establishing key support and resistance levels that might be tested later. Then, as Asia begins to wind down, the London session kicks into gear. London is the largest and most important financial center in the world, and when it opens, things get exciting. Liquidity floods into the market. This is the most volatile session of the day. Price ranges expand, and major trends for the day often begin during these hours. Why? Because you have all of Europe's major economic data being released, and all the big banks and institutional players are executing their largest trades. If a trend starts in London, it often has the momentum to carry through for the rest of the day. For day traders, the London Open is prime time. A few hours into the London session, something really interesting happens. The New York session opens. For about 4 hours, both the London and New York markets are open at the same time. This is the famous London-New York overlap. This period is the absolute peak of market activity. Liquidity is at its highest, and volatility is often explosive. It's like pouring gasoline on a fire. You have two massive financial centers trading simultaneously, reacting to news from both Europe and the United States. Major economic reports from the U.S., like employment data or inflation numbers, are released during this window, causing massive price swings. This overlap is where the biggest moves of the day frequently occur. After the London session closes, the market activity tends to quiet down a bit. But the New York session continues on its own. It's still a very liquid and important session, driven by U.S. economic data and market sentiment. The trends that started earlier in the day might continue, or they might reverse as American traders react to new information. Finally, as the New York session comes to a close, the cycle begins all over again with the Asian session opening. So, let's put it all together. The market moves because of the constant struggle between supply and demand. We visualize this struggle using candlesticks, which give us a detailed story of the price action over a specific period. And the intensity and character of this struggle are heavily influenced by which market session is active. The quiet, range-bound Asian session gives way to the trend-setting, volatile London session, which then overlaps with the powerful New York session for the peak of daily activity. Understanding this daily rhythm is crucial. A trading strategy that works well during the volatile London Open might be completely ineffective during the quiet Asian session. A breakout strategy needs the liquidity and momentum of the London or New York sessions to succeed, while a range trading strategy might be better suited for the calmer Asian hours. By aligning your approach with the natural ebb and flow of the market, you significantly increase your chances of success. You start to see the market not as random noise, but as a structured environment with predictable patterns of behavior. This is the foundation. From here, you can go on to learn about chart patterns, technical indicators, fundamental analysis, and all the other tools traders use. But none of that will make sense unless you first grasp these core principles. Supply and demand drive price. Candlesticks tell the story of that struggle, and market sessions provide the context for when and how that story unfolds. I hope this has given you a clear and helpful introduction to how markets move. It's a fascinating world, and the more you learn, the more you see the underlying order behind the apparent chaos. If you found this video helpful, please give it a thumbs up and consider subscribing for more content just like this. And don't forget to hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one.